So welcome everyone. Thank you for joining us for today's investment committee call. My name is Audrey Wittenberg, Associate Director at LIC, which is the Council of Loma that provides networking and resources for small to mid-sized life insurance companies. We improve performance through shared excellence. And today we have a special presentation for the investment committee. We will be hearing about recent market highlights from Trevor Rupe, who is a portfolio manager at Parkway Advisors. Parkway is a frequent contributor to the investment committee and also a huge supporter of all of LIC's activities. So we really appreciate Parkway very much, and we appreciate Trevor for being here today to discuss the yield curve and other changes and how you can derive the most value from what's coming ahead. So Trevor, with that, I will turn the meeting over to you.
Hello, everybody. My name again is Trevor Rupe, portfolio manager here at Parkway Advisors. I just wanted to first off, wanted to thank Life Insurance Council and Audrey specifically for having me. And again, thank all of you guys for giving up some time on your Friday afternoon. I'll do my best to try to keep things interesting and maybe even have a little fun, depending on your definition of fun. So just a little outline for things to come. Gonna talk a little bit about what we're seeing in the market currently. Then talk a little bit about our management style here at Parkway, and then talk about really, why this all matters, and then why I kind of like the current rate environment that we found ourselves in. So, kind of moving on to the next slide. I'm kind of tired of seeing myself staring at me, so go ahead and get things started now. All right, so first slide here, what we're looking at here is a U.S. Treasury yield curve. So this shows the yields for various Treasury securities starting at about 1 month out to 30 years. The top line there represents the current yield curve for Treasury securities. The bottom one is the yield on securities about a couple years ago, the beginning of 2016. So the first thing you'll notice here is that the yields on current treasuries have definitely increased, predominantly there on the short end. So pretty substantial change, in the past couple years on the short end of treasuries. See the long end, things are pretty much the same. Not a real big change on the long end. So we can attribute this really to a lot of what we've seen, a lot of action that's happened from the Fed. So they have raised rates a total of 5 times, beginning back in December of 2015, followed by 1 increase in 2016, and then 3 increases throughout 2017. Market's still currently pricing in another hike at the Fed's meeting next week, and then a potential 2 additional hikes throughout the rest of 2018. So this policy of increasing short-term rates has caused some changes in the interest rate environment. Specifically a flattening of the yield curve. And so, I'm sure it's not the first time you've heard that term. Anytime you, watch CNBC or read anything, you keep hearing about flattening of the yield curve. I almost feel like we're starting to sound kind of like a broken record here, every time we present a quarterly report to a client. However, I do feel that this current environment has given insurance companies some opportunities to find some values in areas of the curve that I guess might have been, for lack of a better term, neglected over the past couple of years as the low interest rate environment has persisted for longer than, a lot of people have, could have imagined. So just a little bit of kind of what we're seeing in the market, kind of moving on a little bit, about our strategy. Here at Parkway, we continue to believe that the best risk reduction measures for an insurance company to be 1, diversification. And we use diversification as it relates to a percentage of your surplus. So we'll limit, exposure to a single corporate name to, we'll say, 5% of surplus, as opposed to 5% of total assets. This is just a more conservative approach. And when I say single corporate name, we'll actually, take it a step farther and roll that up to the parent company. So example here would be like Burlington Rail. So Burlington Rail is a railroad company that's actually owned by Berkshire Hathaway. We would actually consider that a Berkshire company, so just kind of an additional, more conservative approach to diversification there. The second kind of risk reduction measure we look at is asset liability matching, or we'll call this ALM for short. Basically, it just means you're matching your calculated cash flows from your assets to your anticipated liabilities. So as long as your assets, your invested assets, are producing enough cash flow from both maturities and interest income, you don't need to sell assets in order to meet claims or upcoming liabilities. This is important because when you find yourself in a rising interest rate environment, bond prices will react inversely. So as rates go up, bond prices fall. If you need to sell securities to meet claims, you can end up realizing some losses. So why does this matter? One of the things, like I said, that we like to do here is reduce risk. So diversification, asset liability matching are ways to reduce risk. Through these years, we've seen several methods that insurance companies have utilized in order to pick up some additional yield. The first being stepping down in some credit quality, and the second being investing longer on the curve. So obviously you understand some of the higher risk of default or credit concerns with lower rated securities. However, this also leads to a higher asset valuation reserve, an AVR. So AVR is a reserve that is set aside from surplus in order to protect the portfolio in event of a credit issue. So the higher your AVR is, that's a direct reduction in your surplus. So lower rated securities have a higher reserve held against them, so it's a reduction in surplus. So that risk is a little bit more straightforward. However, the second risk there, investing longer on the curve, introduces a different, less obvious risk, which I'll call an ALM mismatch. And basically what that means is you're investing in securities that have a longer duration compared to the products you're selling or your anticipated liabilities. So over time, we've worked with several companies who have had, we'll call them shortfalls, where your anticipated liabilities are greater than your calculated cash flows from your investments, which, as I mentioned before, does present some risk in a rising interest rate environment. So this next slide here will kind of help paint a picture and help hopefully go into a little bit more detail there. So what we're looking at here is basically just your basic ALM chart. Those blue bars down at the bottom, those represent your liabilities, and so those are what's projected by your actuary, and those are essentially projected outflows from claims, your annuity products, etc. The red line is your calculated cash flows, so that's what your investment portfolio is spinning off, like I said, through interest income as well as maturities. You want that red line above the blue line. You want your assets to be producing sufficient cash flows to meet your anticipated liabilities. The risk comes about whenever your cash flows are not enough to meet your projected liabilities. And this is especially the case as we potentially are moving into a rising interest rate environment. As rates are falling, it really kind of works out. I mean, it doesn't really pose the same risk as it does in a rising interest rate environment, because as rates are falling, bond prices are going up. If you need to sell something, you can sell something, realize a gain, and meet that claim, and that's okay. However, as interest rates rise and bond prices fall, you're looking at potentially selling securities at a loss. And so this doesn't have to happen all at once. You say we find ourselves in a rising interest rate environment. In 2028, you may still have some securities held at gains, or in this case, looking at this specific ALM picture, you may still have some stuff at gains or at break even that you can sell in order to generate proceeds, and that's great. Moving forward, rates continue to rise. 2030 rolls around. You have less options now. You may be selling stuff just at break even, but then 2030 rolls around, 2031 rolls around, and now you're selling stuff at losses because rates have continued to rise. Of course, this is potentially a worst case scenario, but ultimately it's still a risk that you can have within the portfolio if you're looking at things and investing in things without taking into account the ALM picture. And so another risk that kind of happens, and we've seen this with other portfolios in regards to ALM, is companies will try to essentially time the market, and they'll see rates falling and rates are moving down, so they're investing in shorter duration investments there in anticipation of rates continuing or going higher in the future. So what happens when rates don't go higher? We've seen rates continue to fall and fall and fall. So now as these investments that people were buying shorter in anticipation of rates being higher in the future, rates didn't go higher. Now those investments are rolling off, and now you're investing at new lows. So companies who try to time the market have actually seen further book yield deterioration relative to companies who have continued to look at things from an ALM picture and didn't essentially try to guess where interest rates are going. So essentially, ALM just helps insurers look at things from a long-term focus and invest in a way that benefits the policyholder, and really kind of takes away that emotion and guesswork of trying to time the market, which, believe me, you'll definitely get more times than right. Then another, I guess, kind of benefit from looking at things from an ALM perspective comes into play once you have essentially, you've invested in a way that asset cash flows are enough to cover all your liabilities. So in that case here, it would mean that red line is above all your blue bars there. That's a situation that we call immunization. So regardless of where interest rates are going to go, up or down, it doesn't matter. Your asset cash flows are enough, and they're producing enough income to cover all your anticipated liabilities. Once you kind of reach this point of immunization, really your only focus at that point is just looking to buy where you find the most value, or where you can find the best yield on the curve. And so that's kind of a good situation that you will find yourself, with opportunity to review things from this perspective. Moving on to this next slide here. What we're looking at here is a U.S. corporate A-rated yield curve that we saw. This is specific to corporate securities. First thing you'll notice here, the green line is current. The yellow line below that was as of July 2016. So when we were getting pretty close to the lows as far as a yield perspective. And you can really see, again, that flattening effect here, how much of an increase we've seen on the shorter end. Before a 3-month corporate A-rated security was yielding about, 75 basis points versus now, you can hit over, 2.5%. So definitely a pretty big shift on the short end compared to the, essentially 50 basis point increase on the long end. And keep in mind, too, this is just an average of all A-rated corporate U.S. corporate securities. This is across various sectors. So I find it to be a little bit wider, a little bit more yieldy than what you'll see. I mean, it includes some, let's say, some financials or some utilities or some energy names that are generally trading a little bit wider than just your standard corporate names. So not a exact representation of what you can get in the corporate market, but it kind of helps paint a picture here. So one of the things that I just wanted to point out here, one of the first things I noticed is, looking out past 15 or 20 years, on average, you do not pick up additional yield for investing longer than the mid part of the curve. Yes, there's always some exceptions, and yes, you can find, value in different names or industries, but just on average, there's really not that much, there's no more yield investing longer than 20 years. And so, because of this, we've definitely been on our end kind of, focusing on this part of the curve because of the value, but also to kind of improve some ALM pictures because, like I said before, that part of the curve really has kind of, like I said, for lack of a better term, neglected over the years as people were just searching for yield. People were just investing long and buying long or stepping down in credit quality. So yeah, from a yield perspective, definitely a benefit there from the mid part. Once you introduce also another kind of benefit that we've seen from investing in this part of the curve, and that's just the diversification aspect. So on this next slide here, this represents the number of corporate bonds issued throughout any given year, during that year. So as you can see here, from 2002, 2003 to about 2008, we were seeing a lot more issuance of corporate bonds, almost double, even triple the amount of what we've seen in the past couple of years. And because of that, we found a lot, more names to invest in, more ideas, and this really helps from a diversification standpoint. And you can kind of, obviously do some math here and take into account that these companies were issuing 30-year bonds around 2030 or 2005. So that's putting issues, a lot of names right at 2035, right at kind of that sweet spot that we've been kind of looking at and seeing with the yield benefits there. And then I guess one final point kind of wanted to talk about, in addition to not only the yield perspective and what you can kind of find as far as a yield benefit from that part of the curve, and then the diversification standpoint, but wanted to talk about interest rate sensitivity. So shorter duration bonds, along with high coupon bonds, are less sensitive to changes in interest rates. So you won't see market value fluctuate as much as you would if you were buying longer on the curve. So I know books are held on or bonds are held on books for an insurance company at amortized cost or book value. So the changes in market value aren't as important, but given the volatility that we've seen in interest rates, recently, it does give a little bit more flexibility in the event you do need to sell something. So well, let's leave this one here for a second. Kind of take a step back, just to summarize, am I saying that you shouldn't be buying anything outside of 15 to 20-year paper? No, not at all. I think you should continue to focus on investment strategy that benefits your ALM picture and is appropriate for the products that you're selling. Really just kind of wanted to give some insight on some areas that we have been finding some value on the current yield curve. At some point, I think that, could, should, may, will things move to a more normalized yield curve where you pick up additional yield for investing longer on the curve? Maybe, it's hard to say. But, for now, I think the market's still providing a pretty good opportunity to take advantage of the current interest rate environment, while you still can. And so that kind of beckons the next question, when will we see things pick up from the long end? And that's kind of where this next chart comes into play. And this is, so what this chart here basically shows is a yield curve for G7 countries. So this includes United Kingdom, Japan, Italy, Germany, France, Canada. So these are your most economically advanced countries in the world, and you can see where their yields currently are. That green bar at the top there, that represents the U.S. Treasury yield curve there. So in the grand scheme of things, I personally find it potentially harder for us to see a substantial increase on the longer end at the same degree that we've seen on the shorter end, just when you kind of take a broader look at where things are internationally. Right now, the only place you can essentially get more yield is in a 50-year Italian bond, which I would think, I can probably find some better risk-adjusted returns outside of 50-year Italian bonds. But in the grand scheme of things, I still think that the U.S. is probably the best value. And because of that increased demand for especially longer products from the U.S., I can foresee that continuing to hold down rates on the longer end, and due to just increased rate hikes that we talked about through 2018. I do still think that this flattening trend will continue, and potentially even to a greater degree than what we're seeing today. So yeah, that's pretty much my presentation there. I hope that you found it useful, and if you have any questions at all, definitely feel free to submit them into the chat. Also, me or any of my team here at Parkway would be happy to have a greater in-depth discussion with you guys in regards to ALM or diversification, or even any questions you guys may have. We'd be happy to help.